In this chapter, we're diving into inventory costing and capacity analysis. We'll explore how the different costing systems a company chooses can significantly impact the way operating income is reported. Beyond just income, these choices also affect how inventory is valued on the balance sheet, which in turn influences the overall financial statements. Understanding these relationships is crucial because managers depend on this information to make informed decisions. So, we'll look closely at the interplay between costing methods, inventory values, and financial results to see how these elements connect and why they matter. Here, we're focusing on a crucial concept: how the way a company assigns costs to its inventory can actually impact the profits it reports. This isn't just about categorizing or labeling costs differently. The accounting method chosen directly influences the operating income shown on the financial statements. This means decisions around inventory costing have real effects on a firm's financial performance. In Chapter 9, titled The Costing Choice Problem, we'll explore these ideas in detail, especially how inventory costing ties into capacity analysis. Understanding this connection is key to grasping the full picture of a company's financial health. When we compare absorption costing and variable costing, the key difference lies in how they treat fixed manufacturing overhead. Absorption costing includes all manufacturing costs, both variable and fixed, in the inventory cost. This means that fixed overhead gets absorbed into the product cost and remains in inventory until the product is sold. The expense is only recognized when the product is sold. On the other hand, variable costing includes only the variable manufacturing costs in inventory. Fixed overhead is treated differently here. It is expensed immediately in the period it is incurred, rather than being included in inventory costs. As a result, inventory values under variable costing exclude fixed overhead. Understanding these two costing methods is important because it affects how inventory is valued and how profits are reported, especially when analyzing capacity and production levels. This distinction plays a crucial role in capacity analysis and managerial decision-making. Now, focusing on absorption costing, this method allocates all manufacturing costs to the product, meaning each unit carries the full manufacturing cost. This includes both variable costs, like materials and labor that change with production levels, and fixed manufacturing overhead, such as factory rent and salaries that remain constant regardless of how many units are produced. Because of this, inventory values under absorption costing reflect the total manufacturing cost until the goods are sold. This is crucial for inventory costing and capacity analysis since it impacts how we evaluate production efficiency and profitability. Essentially, absorption costing gives us a comprehensive view of product costs by including every manufacturing expense in the inventory value. Now, let's dive into the concept of variable costing, which is crucial for understanding how costs behave in production and inventory. Variable costing assigns only variable manufacturing costs to inventory. This means direct materials, direct labor, and variable manufacturing overhead are considered product costs since they vary directly with production levels. On the other hand, fixed manufacturing overhead is not included in inventory costs. Instead, it's treated as a period expense, meaning it's expensed in the period it is incurred regardless of production volume. Understanding this distinction is essential because variable costing impacts how we analyze inventory costs and manage capacity. It provides a clearer picture of how costs fluctuate with changes in production, helping in better decision-making and cost control. On this slide, we're comparing operating income under absorption costing versus variable costing with the same sales level. Under absorption costing, sales are $900,000, the cost of goods sold is $620,000, which leaves us with an operating income of $280,000. Meanwhile, under variable costing, sales remain at $900,000, but variable costs total $540,000, and fixed manufacturing overhead is separately accounted for at $120,000. This results in a lower operating income of $240,000. The key takeaway here is that when inventory levels increase, absorption costing defers some of the fixed manufacturing overhead into inventory costs rather than expensing it immediately. This causes operating income to appear higher under absorption costing compared to variable costing, even though the sales are identical. This difference of $40,000 highlights how costing methods can impact profit reporting and financial analysis. Understanding this is crucial for inventory costing and capacity analysis decisions. Now, let's focus on why operating income can differ between absorption costing and variable costing. The key difference lies in how fixed manufacturing costs are treated with respect to inventory. Under absorption costing, a portion of these fixed costs is allocated to the units produced and included in ending inventory. This means those costs are deferred and carried forward to future periods when the inventory is sold. On the other hand, variable costing expenses all fixed manufacturing costs immediately in the period they are incurred, regardless of the level of inventory. This difference in cost treatment leads to variations in reported operating income. Understanding this is crucial for analyzing inventory costing and how it impacts capacity and profitability decisions. Absorption costing has an important downside that we need to understand. It can actually encourage overproduction because when you produce more than you sell, the fixed overhead costs get absorbed into the inventory instead of being recognized immediately as an expense. This means that even though you're not selling those extra units, your reported profit can look better because some expenses are deferred in inventory. However, this leads to an inventory buildup, which can mask the true financial performance of the company. This concept is often referred to as the inventory buildup trap, and it's critical to keep in mind when analyzing costs and capacity in manufacturing environments. Let's talk about how absorption costing can sometimes create distorted incentives for a business. The main cause here is the tendency to produce more than the actual demand. When that happens, more fixed costs get absorbed into the units produced, which is an accounting effect. This results in a balance sheet impact because those higher inventory levels carry forward those fixed costs. On paper, this makes the operating income look better than it actually is, since some costs are deferred into inventory rather than being expensed immediately. However, this situation can lead to some issues. The incentive to produce beyond demand might conflict with actual market needs, potentially tying up cash in excess inventory. Instead of focusing on genuine business performance, companies might end up rewarded just for producing volume, which isn't always in their best interest. So, understanding this dynamic is crucial when analyzing inventory costing and capacity, as it highlights how internal accounting methods can influence real business decisions. Now, let's focus on the third method, which is throughput costing. This approach takes a different angle when it comes to product costs. Here, only direct materials are included as part of the product cost. All other costs, such as indirect expenses, are considered period costs and are expensed in the period incurred. In some variations of this method, direct labor costs are also assigned to the products, but that's not always the case. Throughput costing is particularly useful for inventory costing and capacity analysis, helping businesses concentrate on the most variable costs related to production. This method simplifies cost management by highlighting the true contribution of materials to the product. Here we have a comparison of 3 different inventory costing methods: throughput, variable, and absorption costing. Starting with throughput costing, it assigns inventory only the most direct production cost, which means it includes direct materials but excludes direct labor, variable manufacturing overhead, and fixed manufacturing overhead. This makes it the most restrictive method in terms of what costs are assigned to inventory. Variable costing broadens the scope by including all variable manufacturing costs in inventory. So, aside from direct materials, it also includes direct labor and variable manufacturing overhead, but it still excludes fixed manufacturing overhead. This places it in the middle ground for inventory cost assignment. Absorption costing, on the other hand, is the broadest method. It includes all manufacturing costs, direct materials, direct labor, variable overhead, and fixed manufacturing overhead in the cost of inventory. This full cost allocation is required under generally accepted accounting principles for external financial reporting. Understanding these distinctions is crucial because each method influences reported profits and capacity analysis differently. Throughput costing focuses on throughput and capacity constraints, variable costing emphasizes contribution margin analysis, and absorption costing captures the total production cost impact. This framework helps us decide which costing method best aligns with our financial and operational objectives. In absorption costing, the choice of capacity concept used as the denominator for budgeted fixed manufacturing overhead rates is crucial. There are several key capacity concepts to understand. Theoretical capacity represents the maximum output under ideal conditions, with no downtime or interruptions. Practical capacity takes into account unavoidable operating interruptions, providing a more realistic measure. Normal capacity reflects the expected average output over a longer period, considering typical fluctuations in demand. Master budget capacity is based on the production level planned in the budget, so it aligns with current operational goals. Finally, actual capacity is the real output achieved during the period. Understanding these different capacity concepts helps ensure more accurate inventory costing and better capacity analysis. This, in turn, aids in making informed financial and operational decisions. Here, we're looking at the concept of theoretical capacity, which serves as the ideal benchmark for what a facility could produce under perfect operating conditions. This means it assumes the maximum output is possible only if the operations run continuously without any downtime, no maintenance breaks, no breakdowns, no interruptions at all. It's important to understand that theoretical capacity is more of a best-case scenario, helping us set a performance standard rather than a realistic daily expectation. This concept plays a key role in inventory costing and capacity analysis because it helps us measure how efficiently our operations are running compared to this maximum potential. Here, we're diving into the concept of capacity, specifically focusing on practical capacity. Practical capacity represents the real-world operating level of a system or process. Unlike theoretical or maximum capacity, which assumes everything runs perfectly without interruptions, practical capacity takes a more realistic approach. It reflects the usable output after accounting for planned downtime, maintenance activities, setup times, breaks, and other typical constraints that occur during normal operations. This means practical capacity gives managers a more accurate and achievable benchmark to work with. Understanding this helps with inventory costing and capacity analysis by aligning expectations with what can genuinely be produced under regular working conditions. Now, let's talk about normal capacity. Normal capacity refers to the average output a business can achieve over a multi-year period. It's important to remember that this figure is adjusted to account for cyclical demand patterns and seasonal changes, so it reflects a realistic, steady level of production rather than short-term peaks or troughs. This concept is crucial because normal capacity is the most commonly used baseline when allocating overhead costs. By using normal capacity, companies can spread overhead more evenly, avoiding fluctuations that could distort product costing during busy or slow periods. Understanding normal capacity helps in accurate inventory costing and effective capacity analysis, providing a solid foundation for budgeting and performance evaluation. Here, we're focusing on the difference between master budget capacity and actual capacity. Master budget capacity refers to the expected output for the current budget period, essentially, what we plan to produce. Actual capacity, on the other hand, is the output we actually achieve during that same period. It's important to point out that both these measures are less suitable for allocating overhead costs. The reason is that they tend to fluctuate due to period-specific factors, which can introduce volatility. This makes them less reliable as a stable basis for overhead allocation in inventory costing and capacity analysis. Understanding these distinctions helps us manage budgeting and cost control more effectively. When deciding on a capacity level, there are several important factors to consider. First, long-term demand forecasts are critical because the expected sales volume essentially dictates how much capacity we need to have available over time. We can't just plan for average demand, we need to account for industry cycles and seasonality, meaning capacity decisions should reflect recurring peaks, troughs, and cyclical changes in demand. Another key point is capital investment and the life of equipment. Since these assets tend to be long-lived, they commit us to a certain capacity level and influence how we recover costs over the future. Alongside this, we have to think about fixed cost stability. It's important to understand how stable fixed manufacturing costs remain as capacity levels change because this impacts our financial planning. Lastly, management philosophy on overhead absorption plays a big role. The way we allocate overhead affects unit costs, inventory values, and ultimately reported income. This means our choices in costing methods and capacity analysis can significantly influence financial outcomes and decision-making. Here we're looking at how the level of capacity affects the unit cost in inventory costing. When capacity is higher, say 100,000 units, you spread the same fixed overhead of $500,000 over more units. This results in a lower overhead rate per unit, in this case, $5. On the other hand, if capacity is lower, like 50,000 units, the fixed overhead is spread over fewer units, which increases the overhead rate per unit to $10. So, choosing a higher capacity level reduces the cost per unit by spreading fixed costs more thinly. This clearly shows how the denominator, or capacity level, directly impacts the fixed overhead rate per unit and ultimately affects inventory costing. The capacity level we select plays a crucial role in determining overhead variances. These variances occur because when actual production doesn't match the budgeted capacity, the fixed overhead costs won't be absorbed as expected. This mismatch leads to either overabsorption or underabsorption of overhead, which is what creates these variances. Understanding this helps us analyze inventory costing more accurately and manage capacity more effectively. It's important to keep this concept in mind when reviewing Chapter 9 on capacity variances and over- or underabsorption. Now, let's focus on capacity planning in practice. Managers consistently deal with 4 key issues when making decisions. First is demand forecasting, which is crucial because understanding future demand helps us plan the right capacity levels. Next is strategic flexibility, the ability to adjust capacity based on changing market conditions or new opportunities. Then there's the cost of excess capacity. Having too much capacity can lead to wasted resources and higher expenses. Finally, opportunity costs, which represent the benefits we miss out on when choosing one capacity option over another. Additionally, inventory costing and capacity analysis play a vital role in evaluating these factors effectively to ensure efficient operations. These concepts together form the foundation for making informed capacity planning decisions. When capacity is set too low, it can seriously limit growth and create bottlenecks when demand increases. This means we might miss out on potential sales or efficiency because we simply can't keep up. On the other hand, setting capacity too high isn't ideal either. It locks in excess fixed costs, leading to lingering expenses that aren't fully absorbed, which impacts profitability. So, capacity planning is a balancing act, where we need to find the right level to avoid both lost opportunities and unnecessary costs. Ultimately, choosing the wrong capacity level introduces risks and affects flexibility, leading to costs of a different kind. Understanding this trade-off is crucial for effective inventory costing and capacity analysis. In this chapter, we focus on how inventory costing choices affect managerial decisions and incentives. One key point is that inventory costing methods can directly influence reported profitability, which in turn shapes how managers behave. For example, variable and throughput costing methods don't allocate fixed manufacturing costs to inventory. This means there's less motivation to overproduce, because producing more won't artificially boost profits by deferring those fixed costs into inventory. On the other hand, absorption costing includes fixed manufacturing overhead and inventory costs. This can create the illusion that producing more is more profitable in the short term, encouraging overproduction. However, this buildup of inventory can ultimately lead to weaker decision-making, as it masks the true cost of production and capacity usage. Understanding these costing methods is crucial for accurately analyzing capacity and making sound managerial decisions. Now, let's summarize the 3 costing methods we've discussed. First, absorption costing assigns all manufacturing costs to inventory, including both variable and fixed overhead. This method can sometimes encourage managers to build up inventory since fixed overhead becomes part of the stock value. Next, variable costing only assigns variable manufacturing costs to inventory. This approach discourages overproduction because fixed manufacturing costs are expensed right away rather than being deferred in inventory. Lastly, throughput costing assigns only direct materials to inventory, which shifts the focus towards sales and the flow of products rather than on accumulating inventory or increasing production volume. Each method has its own implications, especially in terms of how managers are incentivized to handle production and inventory. Let's delve into how our choice of costing method can directly impact the operating income we report. For instance, absorption costing can sometimes incentivize overproduction because it allocates fixed costs to inventory, which might make profits look better in the short term. Another critical factor is the capacity level we select. This determines the fixed overhead rate applied to each unit, influencing our cost calculations significantly. Typically, normal capacity is used as the standard benchmark for absorption costing, as it provides a balanced approach. When planning capacity strategically, it's important to find a middle ground that manages the risk of under- or overutilization while maintaining enough operational flexibility. Overall, these 5 key ideas illustrate the close connection between costing methods, how we report income, and the decisions we make about capacity. Understanding this interplay helps us make more informed and effective management decisions. As we wrap up Chapter 9, it's important to review the key materials one more time. Focus on how the choice of costing method and capacity decisions impact reported financial results, influence managerial incentives, and guide planning. Before moving ahead, revisit the absorption, variable, and throughput costing concepts to ensure a solid grasp of these foundational ideas. Make good use of the chapter problems and your notes to test your understanding and reinforce your learning. This will prepare you for the topics ahead and deepen your insight into inventory costing and capacity analysis.